You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. But let's do a quick review of last week's trade. We looked at an iron condor in the SPX. And one of the things is the September months are interesting months in general, in that we do have a tendency to get a little bit more volatility. October, the same. But the September hasn't outperformed, or is actually known as one of the worst months over the years. Now, that being said, it does not. The last few years, it hasn't came to fruition as much as it did if you go back over a 30-year time period or a 20-year time period. But just the concept would be that we're a little frothy. Really thought that the new highs where we just kept begrudgingly moved to new highs over and over again might be a little bit over, and it's time to do a more neutral based trade. And we did one in an iron condor. We haven't done a lot of iron condors on Options Playbook Radio, but if I like to do iron condors, I do like to do them in indexes. And one of the things about an iron condor is that you are selling a put credit spread and you are selling a call credit spread. They fight against each other. They want them to stay between the two short strikes. So you have a nice wide area of profitability overall. And you don't want any large move in either direction. So when you're looking at putting an iron condor together, you'd like to look at something that has some volatility with some predictability. And in general, that's an oxymoron. But with that said, that really defines what indexes are. Indexes are made up of, in the S&P 500 case, approximately 500 stocks, and that dampens the volatility. But you still get a good amount of premium overall. First of all, as an expensive underlying index, what right now we're seeing the S&P 500 index, and I should mention that we are taping Options Playbook Radio on Wednesday, September 15th. The market in the S&P 500 index closed up a bit today. We're last trade at 4,480.70, and it was up 37.65 on the day. So a healthy move in the S&P 500 index. Last week, the trade that we looked at doing, we had the market at 4,514, and it was down a smidge on the day. We went out and we sold the 44.60 strike put that expired September 17th. And then in the same expiration, bought the 44.55 put. And that was on the put side. And that's what is most at risk right now. And then on the call side, we sold the 45.85 call and bought the 45.90 call. So right now with the market at 4,480 or 44.80, we are about 20 points away out of the money on our short put. We only have a few days remaining to expiration. The September 17th expiration call options that we sold are selling for next to nothing. You could maybe close that out for a nickel if you really wanted to on the call side. Probably, you might let it ride at this point in time, but it's totally up to you. One thing that it does do is gives you a little bit more flexibility if you have to manage the put side. The trade is up about 40 cents. We're looking to bring in a net credit of $1.33. It's trading right around 90 cents now at the midpoint. We could buy to close out the Iron Condor at that point in time. There were times where the market did come down and you would have maybe got a little bit nervous on the trade and might have altered the trade overall. But in general, if you let it ride, right now you have a winner on your hands and you'd probably just stay the course. And being 20 points out of the money with a couple of days to go, and we got a pretty decent update today, means that I would probably just stick it out for that Iron Condor overall. So with that said, the concept of selling things in September, selling credit spreads that are neutral to bullish if you do it on the put side, or neutral to bearish if you do it on the call side, using out of the money option contracts, of course. I think when you get a little bit of volatility, it just seems like it's a good month to do that overall. I also like on year-end things, and we talked about this on last week's show, like selling calls on positions that I wouldn't mind selling, just trying to get my portfolio all cleaned up for the end of the year, especially if you're dealing with a taxable account where you want to take some gains and you also want to match those up with some losses overall. So you just basically sell the call to target an upside, or you might want to go out and buy a couple puts to protect yourself on the downside to maybe get you to, you got a big gainer stock to try to get you out to 2022. So you'd be buying those puts in January. So around the year end and considering taxes, options are always interesting to enhance your stock portfolio. Now, as always, nothing's meant to be a recommendation here on Options Playbook Radio. If you do need tax advice, please seek out a tax advisor. But a lot of times, these type of trades just make a lot of sense based off of where your underlying stock is trading at and what your goals are coming into the year end. Okay. So very straightforward trade on this Iron Condor. It's kind of fun to talk a little bit about an Iron Condor. But now let's get into a little bit more volatile stock. Coinbase, which is an exchange that does trade in some of the crypto space. They facilitate that type of trade overall. And the company has came public. It's had some volatility, but it actually recently, there's been some news out that made the stock react negatively. And we got a little bit of volatility in it. We're going to go out in Coinbase, and we're going to actually look at a skip strike butterfly. Now, the concept here, a lot of times when I do skip strike butterflies, we'll be looking at it maybe around an earnings report or just a fairly volatile stock in general. And I guess that's the moral to my story is sometimes you don't need an earnings report to add some volatility to the actual prices of the option contracts. And this one kind of fits into the scheme a little bit. It has some volatility, some predictability. Now, I wouldn't want to do an Iron Condor, which we did in the indexes, but I'm going to do a butterfly where I'm going to give myself some upside. I'm hoping to get it done for a net credit to the account. So we're going to skip a strike and basically pay for that butterfly by in theory, selling a credit spread to pay for it. And that's what happens when we skip that strike. That's why I like to call it a skip strike butterfly as opposed to a modified butterfly. But you'll find both of those names inside the options playbook. And if I look at Coinbase right now, I see the last trade was $247.07. It's up $4.07 on the day. but it had a rough week. It had a volatile week overall. So let's see if maybe the news was a little bit overblown and we can get just a small little bump up to the upside. I do not want to be in this position that long overall. As a matter of fact, I'd rather like to do this maybe this coming up Monday so that I don't have the weekend to deal with it. But we're trading that, or we're taping Options Playbook Radio on a Wednesday. The markets are closed, so you got all day Thursday, all day Friday, and it's a little sketchy there overall because you're getting enough premium in this underlying. We right now have a $247 underlying, and it's trading at these option contracts that we're looking at. They're trading at about a 50% implied volatility. So to me, that kind of defines some volatility. Some predictability a little bit, but this is definitely an interesting space overall. And not to mention the fact that it's a fairly expensive underlying, which adds a little bit to the premium. So doing a 1x2x1 is interesting. Overall, targeting a little bit of the upside, but if we are incorrect on our forecast, oh well, we bring in a small credit and help pay for a little bit of commissions on the trade. Okay, so here's the trade. We're going to look at the September 24th expiration option contracts. That is 9 days away. We're going to do a skip strike butterfly, the same expiration for each option contract. That means that we are buying to open the 265 strike call, selling to open 2 of the 270 strike calls. We're going to skip the 275, which would create a normal butterfly, and then we're going to go out and buy the 280 strike call, a much cheaper call overall. By doing that, we're going to add a little bit of risk to the trade relative to a butterfly. We're going to have a 5-point wide spread, which is our maximum risk in this scenario, but that will be on margin. And we can get this done right now at a midpoint of about 10 cents net credit to the account. Now, the maximum it could trade for is $5 if it stopped right at the 270, right at expiration. So that would be a home run, but we're not looking to get a home run in this trade overall. And if the market goes down, all the options expire worthless, and you get to keep that net credit of 10 cents in your account. So if we put this trade on, we got to manage our risk. Right now, we want to know approximately what the expected move would be if, or where the underlying market is at in general. But we're looking at about a 14-point move. So I want to be more than 14 points out of the money. So we went 1775 is where the strike is that we're buying, the 265 strike call. So we need a little bit more than the expected move to get up to our short strike. But if it lands anywhere in between 265 and 275, this you might be able to put this trade on for a net credit and actually close it out for a net credit overall. So you are buying to open, if you will, the skip strike butterfly for a net credit, if you could fill it to midpoint, never a guarantee, of 10 cents. And then you would look, if you could get $1 or even $1.50 on this trade, you'd be looking to get out of the trade. Overall risk is $5 minus that 10 cents that was brought in, or $4.90, or $490 for every 1x2x1 butterfly that we put on. So let's recap it, and we'll leave it there. We're doing the September 24th expiration, 9 days away. Coinbase closed at $247.07. It was up $4.07 on the day. We're going to buy the September 265 strike call, September 24th, I should say. Sell 2 of that same expiration, 270 strike calls, and buy 1 of that same expiration, 280 strike calls. Looking to bring in a net credit of 10 cents to the account. If we could fill somewhere at the midpoint, maximum risk is $5 on this trade minus that net credit, or $4.90. For every 1x2x1 butterfly that you put on, that's a $490 plus commissions of risk overall on that trade. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.